Hello YouTube, it's Alexander here, and today I would like to tell you why I personally hate dividends. Now I would like to say I'm not a financial advisor. This is not financial advice. These are just my opinions, and if you would like to use any of the information found in this video, I recommend reaching out to your financial advisor before making any financial decisions. That being said, I personally do hate dividends, and there are a couple of reasons why. The most important reason is dividends have more taxes than normal capital gains, okay? And this is because dividends are taxed every year, whereas capital gains are only taxed when you sell the stock. Now, to backtrack a little bit, what are dividends? Well, companies can do one of two things when they have extra money, okay? So after they've paid for their expenses, they can do A, they can invest it back into the company. This is where you're looking for a capital gains or a price appreciation, okay? So a company like Amazon, they're gonna take all their extra money, invest it back in the company, and try to grow the company. So if you buy Amazon stock, you're hoping that the price goes up, okay? Pretty obvious, right? However, some other companies, something like Exxon, maybe IBM, well, they've been around for a very long time. They've already grown, they already own their markets. So they have extra money. They have extra money that they cannot invest at a significant return. So what they do is they take that extra money and they give it back to you in the form of dividends, which are usually quarterly, okay? A lot of people like dividends because it's a consistent form of income, right? Because every quarter you're getting money from these companies. And also another pro of them is dividends tend to be less volatile than stock kind of price appreciation. So during a financial crisis, when stocks drop 50%, your dividend income would tend to drop less than 50%. So there's some safety there with dividends versus capital gains. So, there is some pros. Another reason why people like dividends is you can kind of gain exposure to a company, gain more shares. So an example of that would be, if you have 100 shares of a company, and let's say it pays a 5% dividend, well, then you can take that 5% and reinvest it back in the company and buy 5 more shares, right? So then the next year you have 105 shares, you do the same thing, then you have 110, then maybe 116 shares. So you can see how you increase and you get more and more shares, you get more and more ownership. It's kind of exciting. You start feeling like you're building a larger position in this company. The only problem with that is companies that tend to give you a really large dividend, there's a reason. And that reason is they can't really invest it. So often with high dividend paying stocks, you're not going to see really any price appreciation. So even though you gain those more and more shares, it ends up not actually being quite as good as you think. So I would like to kind of give you some examples next, and I'll show you what those are. Okay, looking here, I picked 5 companies that have extremely high dividends, but I want to illustrate the point I was talking about earlier about how you might not get that price appreciation, okay? So I actually didn't cherry pick these companies. I literally just picked the first 5 companies that pay high dividends that I've heard of and I know are large. So I actually looked at this, and actually 4 out of 5 of these companies are worth at least $100 billion. So these are not small companies. And yeah, so what I did was on the right side, you can see here is I looked for how long they haven't had any price appreciation. So a company like Ford is actually trading at the same price that it was 34 years ago. And all of these, even Wells Fargo, 17 years, it hasn't increased in price. So, you got to think, why would somebody own a stock like Ford if it hasn't increased in price in 34 years? Well, it's because of the dividend yield. If you're getting, 13.9%, 10.6%, something like that, you don't need price appreciation, right? You're already getting 10.6% in appreciation for somebody like Exxon. So, if you start with 100 shares, then you could get, almost 11 more shares with that 10.6% increase. So, that's why people like stocks like this. Obviously they hope that price increases, but like I said, you might be surprised. These companies, they own their markets, but they actually aren't increasing in price. It's really just the dividend yield that you're getting from companies like that. So another important thing you have to think about is what is the actual tax rates in America. So currently, most people are taxed at 15%. If you make between $39,000 and $400,000, you get taxed at 15%. Now, I do caution you because, a lot of people do say they like dividend income because it has lower tax rates than ordinary income. Now that's true, but dividends are actually taxed at the same rate as capital gains. So in terms of investing, I don't really like that as a reason for dividend income. But yeah, most people make between 39,000 and 400,000. So I'm going to use 15% for the rest of this video. But yeah, if you make more than 434,000, you're actually taxed at 20%. And if you make less than $39,000, well, you get 0% taxes. Okay, here's an example that shows you kind of the math behind how you can lose money through dividends that you wouldn't necessarily have lost through capital gains, okay? So on the left side, we have an investor that holds a stock just in capital gains, so they don't get any dividend and they just hold that stock for 2 years. On the right side, we have an investor who gets all their return through dividends. They also hold their stock for 2 years, but like I said, all the return is from dividends. They get no price appreciation, okay? In both examples, we're starting with $25,000. We have a 10% return. On the left side, it's a 10% price return. On the right side, it's a 10% dividend return. And they're both taxed at 15%, and they both hold this investment for 2 years, okay? So looking at this, on the left side, you'll see there's just a price appreciation. There is no taxes due because they hold the investment. And then at the end, after 2 years, adding that price appreciation of 10% each year, you end with 30,250. Then you decide to sell the stock. So then you're taxed. Your tax is 15% of the gains. So 30,250 minus 25,000. So you have 5,250 taxed at 15%. It's $788. So you take 30,250, you minus 788, and you have 29,463. So we do the same thing on the right side, except for on the right side, this is the dividend gains. So we're taxed right away. So after a 10% return from dividends, well, we're taxed that year. So we lose $375 that year. And then the next year, we're taxed again. This time it's a little bit more because we have more money. But so this time we're taxed at 407. And our total value is 29,431. But since you were taxed already twice, you don't get taxed again when you sell because all your gains were through dividends. And what you'll see is your final number is actually $32 less than on the left side where you had price appreciation. And this is because you're taxed twice. But look at this. If you add up your numbers, taxes of 407 and 372, that's $782. But on the left side, you were taxed $788. So not only did you get less money after taxes, the government also got less money after taxes. Don't do it. It's not good for anybody. So in the last example, you lost $32 by investing in these high yield dividend stocks. I want to show you here how that number gets a lot worse the longer you hold these stocks. So in this first column, this is the same kind of parameters. So this is holding a stock for 10 years. It's assuming that you initially had $25,000 worth of that stock. On the upper left side here, it's going to be all price return. On the bottom left side here, it's all dividend return. I did also distinguish between a non-taxable and a taxable account because there is some significance there as well. So the first thing I want you to realize from this graph is that no matter what, if you're in a non-taxable account, so this is something like a Roth IRA, it does not matter if you have your money in dividend stocks or in capital appreciation stocks because you're not taxed on anything. So as long as the expected return is the same, you should have the same amount of money. And in both cases, you get a lot, 2.9 million each if you hold something for this long with that long of a price appreciation. Now I would note, in real life you do have things like inflation, so that actual number is a lot less in terms of real spending power. But where the significant difference comes in is this second line right here, okay? And this is showing, including taxes, what your returns are. And you can see after 10 years, there's still not much of a difference between dividend stocks and price appreciation stocks. So if you're going to hold your investment for 10 years, I really wouldn't worry about it. But you can see over time, after 20 years, starting to get a pretty big difference. 30 years, sizable. 40 years, highly sizable. And 50 years, extremely sizable, okay? So if somebody, a grandparent or a parent gifts you some stock when you're young and you have it in, IBM, Wells Fargo, Exxon, one of these stocks, I would recommend switching it to some type of lower dividend ETF, maybe, just a stock that doesn't have necessarily a high yield. And that's because you're going to lose a lot from taxes. So this is off that 15% tax rate. Since this top is capital gains, you're never going to have more than a 15% loss due to taxes as long as you don't sell your stock. If you constantly buying and selling stocks, this compounding effect of taxes still affects you. But if you're holding and you're not selling, you're never going to get worse than 15% because you're taxed once. So even if you hold a stock for 50 years and you go all the way up from $25,000 to $2.9 million, you're still only getting taxed at 15%, and you'll end with about 2.5 million. But look down here, the compounding effects really start to get bad. You'll only have, almost $1.7 million. And that's about 50% of the number you would have if you had that capital appreciation. So unless you think you can, I'd successfully pick these dividend stocks that are going to have a 50% higher return than other stocks, I highly recommend it. I mean, look at this. You're basically getting taxed 43%. If I told you you're going to get a 43% tax on your income, would you be okay with that? No. So why would you be okay with a 43% tax on your investments when you can have a 15% tax? I'll give you more time. Feel free to pause the video and look at this graph. But, the gist of the matter is, compounding taxes is really bad, and it has the same effects as compounding interest. So I caution you, and I wish you the best of luck in your investing.